Atul Suri joins us now. Let's take the conversation forward. Atul, good morning. Thank you for joining us. Atul, they say in the market that trees don't grow to skies, but in this market, that is what is happening. 1%, 2%, sometimes 3%. That is how markets have moved on a weekly basis in last couple of weeks. How long do you think this carnival will continue? And who do you think will get the last ticket for the carnival before it shuts down?
About that. I agree with you, Nikunj, that there is a lot of euphoria, and this is not just in India, this is even global. In US, you've got this very big Robinhood trade play out. A lot of people are sitting at home and feel that they need to make some money. That reflects in the number of new accounts that are also opening in India. And this month, we've had an index that's up 5%, but the FII, DII for the month both have been negative. So one has to be very, very cognizant of what is really happening. And you'll also see that the kind of stocks that are moving, you'll find that the small cap index has outperformed all the other indices, the broad-based indices. There's a mid-cap 500, large-cap Nifty. So there is a lot of retail money that is there. As I said, people are sitting at home and they think that it's a very easy way to make money. And definitely they are doing right now, but these things end very badly. The reason is that most retail investors don't have the discipline of exiting or a case of a stop loss. So one has to be cautious, one has to be careful. And the true test of how this small cap trade plays out will be through a correction. So it is. You have a market that's running away in some segment, but as a fund manager, you have to be very, very cautious and actually are avoiding those spaces. So there is a feeling of being left out. But as I said, history has shown us that very often when people just buy something based on the low price or on liquidity and not based on fundamentals and earnings, the ending tends to be bad. And as I said, when the market corrects, I think you'll get a sense of it. The only way a retail investor can get saved is if he has the discipline of a stop loss. And unfortunately, that's something which I've rarely seen.
Atul, does the bank Nifty run the risk of spoiling the party? Because it was the last one to join the leap and it is the first one which is showing signs of correction. So one side you got a propeller called Reliance, which is the humming engine which is trading the markets higher. On the other side you got banks which are in a sense dragging the markets lower. Now Reliance cannot take the market higher permanently, but banks collectively can do a larger collateral damage.
That the bank Nifty has been an absolute laggard. And in India, by virtue of the composition of the Nifty, to offset the underperformance in banking, you will have to have another counterweight. So it can be technology and Reliance for that matter. On bad days or when there's pressure on the market, you will find that the bank Nifty is going to be the lodestone. It is going to be the one that really pulls the market down. For me, the level of 22,000 on the bank Nifty was very important. The Nifty and Nifty 500, the small, all have kind of broken out. But the bank Nifty was hardly able to get its head above 22,000. And again, the moment it dips below that, I think it's going to be a pressure point. It's going to be the weakest space. So the sector or space with the highest weightage is actually the biggest draw on the market. And I think that is something that can really pull the market down on an index level. So, at the moment, the market is going through a lot of contradictions and there are many things that surprise us. One is itself the market. COVID is not out of the woods. In fact, the number of cases are increasing globally, but the markets, case in point, NASDAQ, lifetime high. You also find that country-wise, some countries are surprising you with the upsurge. In our market, the outperformance of small cap is surprising you. And also this whole factor that at an institutional level, you have net negative figures. There's no return of FIs that is happening. In fact, the selling that has been there in the last 3 to 4 months, just a trickle has come back. So there is a bit of a feeling of mismatch. Things are a little out of whack or things don't seem as obvious as they are. But I guess that's the way the markets are. And at the moment, a lot of small retail investors and a lot of small and mid-cap stocks are making hay. But one has to see how this pans out when the markets correct. And this is not just India, this is globally. So there is a lot of money, there is froth, and that is pushing the market up. The true test will be what are the numbers that come, or what are the kind of narratives that come. How soon is the recovery? Is this V-shaped recovery only in markets, or is it going to be in the real economy? And as I said, that only when markets correct will you get a real sense of where the water settles. So a little surprising, a little confusing at the moment, but sooner or later, I think this will get resolved.
Sure. Atul, from the last time that we spoke to now, the one pocket which has really risen up has been PSU stocks. Be it the likes of a BHEL, BEL, BEML, what have you, the entire space has been as a buzz, or for that matter, Concor, etc. And I could go on adding names to the list. What do you think is happening here? Because, while the fundamentals say that, yes, the government's intent for disinvestment is very well known, it had been even pre-COVID pandemic. But what they're going to do right now is that these are going to be distressed sales. They're going to be selling gold for the price of silver, perhaps, right now. Or I can't even say silver, actually. I believe it gave a good breakout last night. Or perhaps, not get as great a price as they would have ideally wanted. But these stocks are into a different zone altogether. What's your reading on whether or not there is a meaty trade here?
So there's this whole beaten down play is definitely playing out in the market. So a lot of stocks that are beaten down tend to come up. And one of the most beaten down sectors in Indian markets have been PSUs. So definitely these are very cheap in terms of valuations and pricing. It's not that we are going to expect any earnings coming here. So there is no major hope, barring a few pockets. The big play that is happening is a case of divestment. And this play of divestment, this hope of divestment keeps surfacing, whenever there is some talk, etc. But over the years, it's been 6 years or 7 years with this government. And, from day one, we thought this was going to be a priority area and nothing much has happened. So again, as I said, it's a good trade. One has to be selective. And even in this, the discipline of being able to exit as and when the party ends is going to be important, because it's not just that anything and everything that is PSU is good, is going to go up, is going to get divested, is going to have an earnings pickup. So here also you will have to be selective. But as I said, that there is a lot of retail froth in the market, and they love such stocks which are really beaten down, which are, very low priced. And that is adding fuel to the fire. So this is something you're seeing across sectors. So you'll see that even if you see on a 3-month basis, probably the best performing sector would be autos, apart from the small cap index. And one of the least or underperforming would be something like FMCG. So you will realize that the market is gravitating on a hope trade. The feeling is that we will have a V-shaped recovery, and these stocks have been beaten down too much. So there is money that is moving into that space. But as I said, that it's only when we start seeing numbers and the narratives from managements, and when markets correct, we will really understand that how many of these still stand out. And ultimately, the stocks that stand out will be the ones that are worth a look at. Just getting into the froth or just getting into it because the prices are going up is very, very challenging. It is great for investors, as I repeat, with discipline. Most others are going to get hurt.
That's interesting that you say autos, Atul, because, that's where the first sort of yellow weeds or green shoots, whatever you may want to call it, have come in from. Be it Escorts, be it M&M and the tractor sales, and the rural recovery is something that the market has really caught fancy to. Besides that, what's also holding out is this entire move that's taking place in ancillaries. But would you be brave enough to stick it out of the tractor space and dabble into passenger vehicles or some of the CV names, for instance? Or do you believe that stick to where the fundamentals are sorting themselves out?
Well, I think that is an interesting space. This whole rural theme is playing out, and initial reports are that this is where the revival or the strong point in the economy is. So even in the auto space, one would have to focus on themes that are direct beneficiaries of this stronger rural theme that is playing out. But as I said, that, don't look at markets on a 3-month basis. If we look at markets on a 3-month basis, we find that a lot of very, very differentiating signals are available. What you need to see is the market in a longer term. And you will have to see that post this beaten down or oversold rally that we are experiencing, where are companies that are going to consistently perform? And if they have corrected in this market, you get a better price for it. For sure, you need to be logged into those spaces. Ultimately, we are not traders, we are trend investors. And I still think that just buying anything just because it's beaten or because it's cheap is not a strategy we would like to follow. We like to ultimately look at those companies where there are going to be sustainable earnings in the long term. And I think those are trends that will emerge for the next 2 to 3 years. So even in this rural theme, there are a lot of stocks, a lot of sectors that will benefit. But once you get a sense that this is not going to be 1 quarter game or 2 quarter game, this is going to be a 3 to 5 year space, I think that's when it's worth putting your hat in. You have to be able to differentiate between a trade and an investment.
Okay. Fair enough. Atul, how does one invest in a stock like Reliance? I mean, let's see, if we take a look at the kind of move it's seen, 120% from March lows. So on one hand, if somebody still wants to get into this stock, take advantage of what's bound to be very positive commentary coming out of the AGM in terms of future outlook, how does one do that? Because on the other hand, you're actually running a risk of getting into an overbought stock.
So I really can't comment because I have a vested interest. I hold Reliance in my portfolio. But Reliance is one such stock which, as I said, it's a sector in itself, so it cannot be ignored. And second is the weightage it has in the index. So in spite of owning the stock, yet you can underperform simply because the weightage that Reliance has in its portfolio or in the index or your benchmark is so high that very few people have that level of exposure to Reliance. So Reliance is a very, very enigmatic stock. I think the stock has almost doubled from the bottom. Where your index may be up 30% or 40%, and this stock is almost doubled. So the fact is that maybe 1/3 of this rally is thanks to one stock. The question that is that whether you put your hat into or no is ultimately a question of where do you see Reliance 3 years from now. As I said, I do not know what's going to happen in the next 2-3 days or 5 days, but you have to take a call on what you think or where you think Reliance will be 3 years from now. And as I said, that we hold it in our portfolio, so can't comment on entry levels, but definitely a stock you can't ignore, especially when you have a benchmark and where it's the largest component of a benchmark. That just doesn't go for me, but goes for all PMSs and mutual funds. It's a stock that always, if you have it, you always have less of it.
Okay. Yes, fair enough. Atul, with the recent trend we've seen and the rush of retail investors trying to get into equity markets directly vis-a-vis mutual funds as well, where do you feel there is the best possibility for them in terms of protecting capital as well as assured returns? Would it be in the defensive, such as IT, for example, that has started to make a resurgence? Or stick to, even though they're slightly highly valued, but stick to the other preferred names, for example, in the consumer pie?
I think the times are very challenging because we've had a massive reset, and not just a retail, but even as professional investors. As I said, the question I keep asking myself is not about 3 months, but 3 years. And which stocks, which sectors are going to emerge much, much stronger. So we are going to see a shift in market share. And just as in demonetization, we saw that some companies became stronger, became larger, and the rally they had after that was phenomenal. I think this is going to be another such event. And as an investor, even I don't have perfect answers because no one has perfect answers. We don't know how the end game is going to be. But the thing is that look at businesses which you think are going to be better off 3 years from now. Because in this crisis, a lot of businesses are going to shut down. A lot of businesses are going to give away market share. And we all experience that. You go to ask family and friends around and you will realize that a lot of people are going to vacate spaces. And who are going to take away that space? Who are going to take away that market share? And I think that I am looking at markets 3 to 5 years hence, because I feel that if you get logged into the right stocks or right spaces, just as we saw post demonetization, you had a clean 3 to 4 year run in a certain space of the market. I think this will give you an opportunity. In fact, I think it may be a bigger opportunity. So I would rather look at businesses, markets, stocks 3 years from now, and because there's going to be a lot of money to be made in that time frame. In 3 months, I do not know, because good news, bad news, politically, US elections, there are a lot of variables in the short term, and they can upset you or throw you around. But I think that if you give it a 3-year time frame, I think there's no better time to be an investor, no better time to do stock picking than it is right
now. Atul, so what is the best way of looking at where Nifty is headed in next 3 years?
Then Nikunj, the first thing that comes up is that we broke out of this 10,000 level, which was very, very important. This was equivalent to 22,000 on the Bank Nifty. The Bank Nifty could not do it, or hardly did it very unsuccessfully, I would say. The beauty is that the market went on to go to 10,800. Around 10,880 or thereabouts is also the 200-day DMA. See, the 200 DMA is probably the most followed indicator globally, because it's a very good reflection of bull and bear markets on a very simplistic manner. The US, you find that most of these markets have crossed. India just is below that, just around 10.8 or thereabouts. So I think that is going to be the first crucial resistance point. But beyond that, I feel that 10,000 will emerge as a very strong base for the market. I don't know how much the markets can correct, when they will correct, but I think anything bought nearer to that or somewhere there, I think will pan out very good. The big story or the big move that I think is to around 12,500, which is something which is the target in the medium term, which is substantially higher, even 20-25% from thereabouts. And over and above that, I do think that given some time to the market, post-COVID life will go on. It's not that life is going to end. Yes, we will have a solution. It's the end of the year, first quarter next year, we don't know. But post that, I think there are going to be some businesses that are going to be major beneficiaries. They are going to walk away with market share. And that is where we should be focusing on. That is why I feel that we are getting markets or an index level, which was there even 2 to 3 years ago. In 2017 also, we were at around 10,000 or thereabouts. So we are getting index levels, we are getting stocks at those levels. The only thing is that we have to put on our hat and try to visualize and monitor companies and sectors which will play out. And I think that this will be one of the best of times to invest in, because historically, we've done studies for over 100 years. We've seen that whenever VIX, volatility of fear, reaches these levels of 85 to 90 levels, the years that follow that are the best equity return years. The only problem is that at these points in time, fear and panic is the highest. And that's a line by Buffett who says that be greedy when you all are fearful. People are extremely fearful. People just keep asking, what's wrong with your market? How is it going up? Nobody wants to put their hat in the market. So I think that from emotional point of view, from an index point of view, from an event point of view, this is finite. This is going to end. The important thing is who are going to be the beneficiaries, because whatever emerges from here is going to be a disproportionate gainer. And those are the spaces I want to be in my portfolio, because that is going to be a sweet ride post this.
So if Reliance has turned out to be a disproportionate gainer, where do you think you're getting evidence or signs of disproportionate market outperformance or underperformance? Atul, money can be made both ways. You're a trader, you understand that. Banks have been disproportionate underperformers. A combination of telecom and perhaps Reliance and pharma has been a disproportionate amount of gainer. So let's say if you have to strategize your portfolio to benefit from these disproportions in the market on the upside and on the downside, how would you lay your bets?
So clearly telecom, and Nikunj, you don't need to really wait for some analyst report. You have to look at your own household. I mean, one product or one service we are consuming double in every household is internet. I mean, it's your house, my house, or the viewer's house. Everyone has upgraded their internet packages. And this is something where we know a new reset, a new way of working, entertaining. This is not going to come down. So first and foremost is I think that telecom is a clear winner, and Reliance is a case in point, and there are a couple of other stocks also. Pharma is another sector which has been a little quiet for the last 1 month, but I do not see any country, any individual reducing their budget towards pharma and healthcare. I think the world has been found wanting in terms of infrastructure in pharma and healthcare. And I think that this is a sector which is going to see massive allocations for the years to come. So I think that, apart from all the analyst reports and things like that, I think you just have to look around you and see where your consumption has doubled. These are changing habits. Look at what you are viewing. Look at Netflix or Amazon Prime or Hotstar. How entertainment has changed, how viewership habits have changed. And these habits are permanent. I think working from home is another reality that is going to happen. So I think there is going to be a major reset. One is, of course, as I said, what analysts feel, but just use your common sense and see how your consumption patterns and how patterns around you are changing. And sooner or later, these will start reflecting in companies and numbers. And these are going to be the mega trends that will play out. And I think these mega trends is where I think wealth will be.
Atul, appreciate your time.
Thank
So
you.
good to
Thanks
have
for
you
having me.
back, and so good to connect with you. Stay safe, my friend, and thank you for joining us.